Sawadee-kap, Tukkan. Hello everybody, Graeme Cunningham, Global Investment Strategist here at Asia Plus Securities. This is Global Market Talk. Today we're going to talk about banks, specifically the US bank results and the details on these results, looking at the difference between the commercial bank and the investment bank, because that becomes a major issue when you're looking at US bank results, and the several banks are actually a combination of those two things. So we can go to the first slide. So we can see that US banks, what this chart shows is the actual reported first quarter 2017 EPS versus the estimated EPS. So analysts, all the analysts that are covering these banks have an estimate, and they take an average of those estimates, and that gives us the expectation for the quarter, and then the actual number comes out for the actual report, which came out in the last week, and then we can compare those two numbers, and then we get how much they either beat those estimates or miss those estimates. So we can see for the US banks, for the first quarter, pretty good quarter. In general, most of the banks were beating estimates. The weaker performers that stand out are Wells Fargo, which was broadly in line, just 2% above estimates, which we consider to be pretty much flat. And Goldman Sachs, which historically has often beat estimates, actually was a big underperformer, under estimates by about 21%. But the rest of the group was doing pretty well. If we go to the next slide. Now this compares the actual first quarter 2017 earnings to the actual first quarter 2016 earnings. We can see that there's actually pretty strong growth year on year for most of the banks, again, except for Wells Fargo, which saw relatively flat growth, down about 1%, pretty much flat. The big outperformers versus the sector were Bank of America, which went up 108%, the earnings year on year, and Morgan Stanley up 83% year on year. But in general, other than Wells, all of the banks saw over 10% growth in earnings year on year, which is pretty strong. So both those things look good. Year on year growth was strong, and it also beat estimates. We would think that that would probably be good for share prices. Interestingly enough, though, if we go to the next slide, actually it wasn't really that liked by the market. This is one of the things I want to get into today, is why, when you have decent growth and you have generally banks beating estimates, why would you have this decline? If you look at the far right of my chart here with the circle, you can see that around the 12th of April that week, there's actually a decline as these banks' results come out. So what's going on there? If we go to the next slide, I'd say it's two factors really. One is the sustainability of earnings, and that's going to take us into the main part of our discussion today, where we talk about the different types of banks and how they make their money and how sustainable different parts of their earnings are. And then we're also going to talk about relative valuations. So in the US, there's been a lot of hope for a boost to banks from the new policies of Donald Trump, which has really pushed up valuations. So you're starting to get to a point where people are expecting quite a lot in terms of the valuations have moved ahead, expecting earnings are going to be good, and then you have to have earnings actually catching up with those expectations now. So you're going to need these beats to keep those valuations up there. But we'll talk about that in the second section. So first, let's look at sustainable earnings in terms of banks. That's going to lead us to talking about the difference between a commercial bank and an investment bank. If we can go to the next slide. So here we have the basic income statement of a commercial versus an investment bank. So what I'm going to focus on today is actually the first 4 lines in the discussion. So you can see that that adds up to total operating income of 100 for both of those banks on the left and the right side. I'm going to focus on that today, but very briefly, we also need to talk about the lines underneath total operating income, which are not the focus for today, but I don't want to completely not touch on those because they are a fundamental part of the difference between these two types of banks. So under total operating income, if we go back to that the total that slide, yeah. So underneath total operating income, both of the banks also have a similar cost of 50 each. What are those costs? Those costs will generally be personnel costs will be your largest cost. So people are the largest cost of banks. There's also telephone calls and documents and things like that, building costs. But really, people is the big cost of banks, the most important cost. So you can see for both the banks, that's the same case. The differences between these two banks is you'll notice the second green line under commercial banks, provisions. And you'll notice investment banks doesn't have that line. What commercial banks do is they make loans, and some of these loans over time will go bad. Some people won't pay back their loans, or will pay back loans more slowly than the bank thought, and they have to make provisions because they hold these books they hold these loans on their books over long periods of time. So investment banks don't really do that. They don't really generally don't hold large commercial loans on their books for long periods of time. So they don't really have to worry about that type of cost. Now, for the first quarter 2017 U.S. banks results, the provisions issue is not really a major issue right now because it's not really moving that much. The big moves is coming from the operating income line. But I wanted to address this, and this is really a topic for another day where maybe we see rapidly rising bad debt and then rapidly rising provisions and then falling net income for banks, especially commercial banks as we've covered. And that can certainly be a huge issue. For instance, 1997 in Thailand, the operating income line of banks was basically not even an issue. It was really the provisions line, and soaring bad debt and soaring provisions was the entire story. But for right now, first quarter 2017 U.S. results, you're not seeing huge shifts in the bad debt. You're not seeing huge shifts in the provisioning. So it's not really that much of a driver for this quarter. But it can be, and you always want to be wary when you're looking at banks of rising bad debt. And where that comes in, it really comes in at that provisions line more than anywhere else. But for today, we're going to focus on just on the operating income side of commercial banks versus investment banks. So we can go to the next slide. Okay. So if we look at commercial banks and we look at the large blue section, which is about 70% of the operating income, we can see that that is the bulk of a classic commercial bank's operating income. And what they do, it's pretty simple. They take in deposits from people like yourself, the general population, from corporates, and they pay, let's say, 2%. They take in, let's say, 100 in deposits, and they pay 2%. They take the 100, they lend it out, making loans at, let's say, 6%, and they make a net interest margin, so the 6% that they're lending at versus the 2% that they're paying to you, they make a net interest margin of, let's say, 4%. That's the basic business of a commercial bank. Now, the other way they make money is a smaller percentage generally is net fee income, which we can see is about 15% of earnings in this example. A classic example of net fee income would be ATM machine. You go to an ATM machine that's not your bank, you got to pay a fee, the bank collects that fee. So simple. again, a relatively stable and core component of the bank earnings. Other operating income is another 15% of the bank. This tends to be the less stable component. It can be things like Forex business, a foreign exchange business where they exchange money. It can be gains and losses on investments that they're making, or maybe an insurance business. In general, that tends to be a less stable component of earnings. Now let's look at the investment bank and how investment banks make their money. Quite a bit different, actually. Their big blue component, the most stable and the core component in a classic investment bank, would be something like a stock IPO. So a new company, a company wants to go onto the stock exchange. The investment bank helps them do that and collects a fee. Or an existing company wants to raise debt, needs new debt capital. Again, the investment bank helps them and then reaps a fee. Or two companies want to merge together, or one company, big company, wants to acquire a smaller company. Investment bank comes in, helps them do that, and then takes a fee. That would be a classic investment banking model. Now, the other thing, generally, these investment banks have expanded their businesses. They'll often have an asset management business. That's pretty simple. They would, let's say you have 100 baht in assets, you want someone to invest it for you, you're not trading it yourself, you give it to them and they would invest it in different instruments and equity and bonds and REITs, and then you would pay them a fee of 1% to 2% to manage those assets. So that would be another component of their earnings and is often a component of investment banks today. The third component, it's similar to what we saw in commercial banks. The third component is this more volatile component of earnings. So the blue component for both of these types of banks is pretty core, pretty big and stable. The green component, both asset management, net fee income for commercial banks, asset management for investment banks, is a little bit smaller, but also core. And then you've got this third component, which is more of a much more volatile component. For investment banks, this could include trading for their own book. So they have their own capital, and they go out there and play in the markets, trying to do short-term trading, like you would maybe if you were a day trader and you were trading for your own portfolio, trying to make money on the day. And the swings that would incur, and if you're a day trader, you probably know there can be pretty big swings depending on how you position yourself from doing that kind of activity. So the key point is that in the classic structure, actually these banks are, although they do very different kind of businesses, they sort of have a same sort of breakdown in terms of the core stable business, smaller supporting core business, and then this volatile component. Now, why does this matter for U.S. banks' results? Okay, the reason is because, one, a lot of these banks are a combination. They're not a commercial bank or an investment bank. A lot of them are a combination of the two, number one. Number two, this volatile component, especially for the investment banks, we saw that in our model, trading for an investment bank was maybe 20%. For some of these investment banks, trading is now 40%, 50%, 60% in a quarter. So these very volatile components of income have actually become, in some periods, the majority of the earnings. So you can see how that gets quite dangerous, because you can have these big swings in earnings. Now let's have a look at the detail of this if we go to the next slide. So this gives us an idea of what is the split for these banks that we've seen report. What's the split between commercial banking and investment banking? Let's look at the pure plays first, so the ones that only have one component. So you've got Wells Fargo. That is a pure commercial bank. All they do is, as we saw, they do mainly the taking in deposits, lending out, collecting fees, and a little bit of other operating income from maybe Forex or other operations. But really what they do is pure commercial banking only in the US. They're not international either. So if you wanted a pure play only on your idea was U.S., Trump's doing well, things are going to be good for the U.S. in general in banking. That would be a potential, theoretically, a direct play on that. Now, to the other side is the pure investment banks. Goldman Sachs and Morgan Stanley, which in the chart are GS and MS to the far side. You can see they're 100% investment banks. They don't do any of the commercial banking. They don't take in deposits. They don't make lending from the deposits. They just do what we talked about. They're doing the IPOs, the M&A, the asset management business, and then they're also trading. And both of these companies are heavily trading. So that model that we saw of a classic investment bank doesn't necessarily apply for GS and Morgan Stanley, which have really large proportions of their income coming from trading, which, as we know, can make things volatile. Now, in between, we can see we've got a bank like Jpmorgan, which is almost perfectly split 50-50. Why is that? Jpmorgan, many years ago, merged with Chase, which is a commercial bank. So what you have is literally a commercial bank, an investment bank, merging together, and then you have a 50-50 split. For something like Bank of America, 56% of the bank is an investment bank, and 44% odd is a commercial bank. So a little bit more, when you look at Bank of America, it's a little bit more of an investment bank than it is a commercial bank. For Citi, 66% of the earnings is an investment bank. You're getting more and more towards an investment bank, although you think of Citibank probably as a commercial bank, which it is, 34% of it. It's actually very heavily involved in investment banking in terms of its operating income. So you can see that when you get into these banks in the middle, there's a lot of moving parts, and it's not that simple. When you see these year-on-year growth numbers, you really have to see where is this growth coming from to determine whether that's really good news or not. For instance, if all of the income boost has come from a very volatile trading quarter where they made huge gains, that could potentially be a loss the next quarter just as easily. So you have to look at the composition of the earnings. It's important when you look at these U.S. banks. Okay, so let's go back to the next slide. I'm repeating this slide again. Now let's look again with the newfound model that we have. Let's look at these results one more time. So now that we can see that Wells is a 100% commercial bank and what that means, we can see that actually people have been expecting a lot. WFC Wells Fargo is kind of an indicator, as we said, of pure banking in the U.S., commercial banking. We can see that actually it's flat. The year-on-year growth is not really doing that much. So these expectations that Trump was going to drive a very quick increase in these banks is not really coming through in the numbers. It's maybe a bit early to judge, but so far not that much has happened in first quarter. Two reasons for that. One is that loan growth is actually starting to slide a bit for most of the banks, slide towards zero. The other issue is that net interest margin that we were talking about. One of the big stories for this bank is that the net interest margin will expand. Remember we said in our example, you take in 100 in deposits and you loan it, you pay out 2% to the depositors, and then you loan it out for 6% and make a 4% spread. Fine. One of the ideas was that interest rates were going to go up. So generally what banks can do is they can, the deposits are in there for a reasonably long time, and depositors tend to not move between banks unless there's a big change in deposit rates. So as long as deposit rates don't move that much, they'll tend to keep their deposits there. So as the interest rates go up, banks can slowly increase the amount that they're charging on their loans. So let's say they went from 6% to 7%. So now I'm paying the depositors out maybe 2% still, but I'm making 7%. My net interest margin has gone from 4% to 5%. So that was a huge part of the Trump reflation story was that net interest margins were going to increase. Actually, for the commercial banking side for these banks, we really haven't seen that really come through. Again, it's early days. We really need to look at second quarter, third quarter to see if that happens. But so far, it's not really coming through. Okay, so that's the commercial banks. Now, the interesting part, if you look at the back to the Bank of America's 108% year-on-year gains, and the Morgan Stanley's 84% year-on-year gains, a lot of that is from trading. And actually, as we've said, this trading income can be pretty volatile. We don't know if Bank of America and Morgan are going to be able to sustain these things, just to sustain the trading growth, and the core business is doing okay, but it was really boosted by that trading income. So this is why maybe people see these numbers, they think, okay, those are good, but is it sustainable? That's why I come back to my first thesis, is sustainable growth. Can they keep this trading, this strong trading going? Because there's swings in markets, and it's a difficult thing to do. Goldman Sachs, the final thing to talk about on this slide. Interesting, right? They're again a huge, definitely trading focused growth here, 60%. It's interesting they were underestimates by 20%, even though the growth was 60%, which is really high year on year. Which just shows you the standard that the market was holding Goldman Sachs to. So it's as much about, when these earnings come out, about the expectations, the historical expectations. See, Goldman, since 2011, I think, has basically beat Morgan Stanley on a quarterly basis in terms of their trading. So this is one of the first quarters where we're seeing Morgan pull ahead. So it's a bit of a shock to the market. So it just shows you that you can't always assume that trend that you've seen that's been stable for so long is going to continue, and it can be a bit of a shock when it doesn't. So something to think about is always be looking for those turning points, looking for hints of turning points in shifts. Maybe Morgan Stanley starts to become dominant over Goldman Sachs for a while, for a year, who knows? Again, it's hard to say with trading, and it can really swing. This is why an investment bank that is more, doing a lot of, getting a lot of deal flow on their core investment banking income, has a big asset management business, maybe something like that is a little bit more stable than just relying on trading income. Okay, so that's sustainable earnings. One last point on relative valuations. So here's another issue. I have not included Goldman Sachs and Morgan Stanley in this. I've included the 4 U.S. banks. If you look at the green circle, that shows you where the U.S. banks lie. Just quickly, I need to explain this chart very quickly for you. For higher returns, I'm happy to pay more. That's the basis of this chart. So if you look on the x-axis, I've got return on equity, which is returns. So if returns are 2%, the market will pay about 0.5 times price to book. And price to book is basically a price on the y-axis. As we get up to returns of 10%, we can see that the market's happy to pay 0.8 times price to book. And as we get up to returns of somewhere around 14, 15, 16%, the market is happy to pay 1 times price to book for these banks. It's based on relative valuations. Now you could say the entire banking sector is quite lowly valued compared to the rest of the world, which it is, but generally what you do when you price assets is you price them relative to each other. So what we can see from our green circle is that most of the U.S. banks are above the line. WFC, which is one of the most highest above the line trading banks, that's Wells Fargo. Jpmorgan, which we talked about, Bank of America. All of these things except for Citigroup, which is near the line, which looks reasonably fairly valued, are actually quite highly valued. So when you have earnings come through and you have high valuations, the bar is much higher. If you have something where it's pretty cheap already and estimates come in, or actual earnings come in, they're not that much higher than estimates, or even a little bit below. If I'm paying a really cheap price for the asset already, maybe it's not really that big of a deal. I'll just keep holding on to it, thinking things will get better. If I'm paying a high price, like something like Wells Fargo versus the rest of the comparables, other banks that I can buy, then maybe I won't be as impressed in terms of earnings not beating estimates, because I'm already paying a pretty high price for this thing. So I paid high price because I expect things to be getting better and better and better. And when they disappoint, which is called an earnings disappointment, when when a company misses its estimates, then I might be more inclined to sell that off and look for other assets that give me a better return. So that is the two topics for today. We covered U.S. First quarter banks' earnings, the components of those banks' earnings, the difference between a commercial bank and an investment bank, and how many of these major U.S. banks are a combination of those two things, and how although we did see decent growth and we saw an earnings beat, because of a combination of issues with will these earnings be sustained, will these beats continue, will these high growth levels continue for the rest of the year, and the valuation issue with the U.S. banks not being particularly inexpensive right now versus the rest of the global banks, that people were a bit disappointed overall in terms of these earnings. So thanks very much. That's all for today. Again, Graeme Cunningham, Global Investment Strategist for Asia Plus Securities. This is ASP Global Talk for this week. Join us again next week, where we'll talk about whatever the interesting news is that comes up for the rest of the week at 3:30 on Thursday. Thank you very much. Sawadee Krap.